All right, everyone. Welcome to our Trade Earnings Like a One Percenter webinar. And what I'm going to do here today is I'm actually going to show you a couple of stocks that I'm looking at going into earnings, as well as something I call layering what we call rules-based trading systems. All right. Again, my apologies for being late. Had a couple of little things that were going on. I had a meeting. I had a little traffic that wasn't expecting, even though I did leave early, and then of course. Had a little computer trouble here, but we got everything fixed. We're ready to go. Thank you all for being here and being on time and sticking around for this. I promise you're going to learn something here. And I've got something really special for those of you that are new that we typically offer to our members. So I want to show you that as well. Before we continue, Jay, are you there?
I am here, Tom.
Awesome. So Jay's going to be manning the boards there. If you have questions, comments, etc., you can put them in the Q&A box. I want to apologize to you right away because I know we're not going to be able to get to as many questions as we have out there. But again, I will get to them as quickly or as we possibly can. I got a couple questions for you, too, especially those of you that are new in the room. So before we get there, let's take a look at this disclaimer box here for a moment. I am going to point out just a few areas in here that I think are important, all right? Number one, stock and option trading has large potential rewards, but also large potential risk. You must be aware of these risks and will accept them in order to invest in the stock and options markets. Now, the other thing is that me, Jay, and everyone with Tom's Trading Room here, we are your educators. All right, we're here to educate you about rules-based trading. We're not brokers. We're not investment advisors. All right, we don't offer individual investment advice. Everything we're going to talk about today is in U.S. dollars unless noted otherwise. And you can read this from cover to cover. I will be putting the recording out for this shortly after the live event. Okay, so let's get rolling here. We're going to talk about trading earnings like a one percenter. We're going to talk about something that I use called the money calendar and actually how to intertwine those. But I got a couple questions for you. So this is what I want to do. I want to start off with these three questions. I'm going to poll the audience. So I'm going to poll everybody in the room that's in here right now. I would like you to answer. Don't worry. You can select. It's just a multiple choice. All right. And your name will not be shown. All right, I want to let you know that immediately. I don't know who's answering these questions. Your name won't be shown. I simply want to get an idea of who we have in the room. All right. So, and what I mean is the type of trader. So let's go ahead and get started. First question I have for you, because we have some new folks in here, is what is your experience with options? All right. What is your experience with options? All right, select one of the following right now. So either you're a beginner to options trading. All right. I know enough to be dangerous. That's an interesting one there too. And those of you who know, you know who you are if you're answering that one. I know options fairly well. Then, of course, we've got some of our partners in here. So let me know if you're a partner, Tom's partner, past or present. That'd be great. All right.
And as a reminder, Tom, they got to click on the radio button there, not type it into the Q&A box.
Yes, please. we do get that every once in a while. So you just click on the little button just to the left of one of those answers. All right. So I am going to close up the polling now. All right. Thank you all for voting. And we got most of the room in here that voted. So let's see how what those results look like. All right, so Jay, so only 13% of the room are beginners. That means that they've heard of options, but they haven't done anything with them. 33% know enough to be dangerous. You are my target audience for today. Well, all of you are, but I want those of you that are in the beginner camp or know enough to be dangerous camp to really think about what it is that we're doing, because it's not just about options trading. All right, it's about selection. It's about stock selection. And it's really about research and researching things outside of what 99% of all option traders do. I know options fairly well. I know that I can also appeal and help to you. And those of you that are partners of ours, well, what you're getting is a refresher of what we typically do on a regular basis, and that is what we call rules-based trading. All right. Rules-based trading is very simple. It's a way of looking at the markets and finding patterns in the markets, then finding out whether these patterns are actually profitable, and then, again, going forward testing before committing any money to these patterns. And that's what we do here at Tom's Trading Room. We do precisely that. And we found rules-based trading in a number of areas. We've found them in not only something like the money calendar, which I'm going to show you today, but we also have contrarian-based trading patterns. We have probability-based trading patterns, volatility-based trading patterns. We've come up with a really nice group of different things that can complement each other. Next question that I want to share with you is, this one's a little bit tougher. All right, are we ready? What's the best way to measure liquidity to an options trader? All right, I got 5 of them there. All right, answer one of the 5. Number 1, stock volume. Number 2, option volume. Number 3, open interest. Number 4, bid-ask spread. Number 5, I have no idea, please tell me. All right, if you could select one of the buttons there. Now, we have asked this question before. I've asked this question for years. And it's amazing the different types of answers that we get, because every one of these answers in here is not a bad answer, but there is one that trumps, no pun intended, there is one that trumps all the others. All right, so let me close up the poll here. I'll give you 5 more seconds. Just vote on any one of those. That'll be great. And here we go. And results are, well, 6% says stock volume. 16% said options volume. 25% open interest. 40% bid-ask spread. And 14% I had no idea, please tell me. Jay, what's what was the TV show where you got to you phone a friend, or you could poll the audience, or
Who Wants to Be a Millionaire?
Yeah, I think so. So if you were to poll the audience, which one would you go with?
Take your lifeline, huh?
Yeah. You're going to go with bid-ask spread because that's what most of the audience said. And most of the audience here is correct. All right. Yes, stock and option volume do have a lot to play in, what happens day to day. But the best way to measure liquidity for an option trader is to look at the difference between the bid-ask spread. And the thinner that bid-ask spread is, the more efficient it is. And it doesn't matter whether you have 0 volume that day or you have tons of volume. The bid-ask spread tells you that there's a lot of buyers and there's a lot of sellers at those particular price points. And you're going to see a trade that I just looked at about an hour ago, and I'll show you the bid-ask spread on it. And it's a pretty popular stock. I mean, it's one of the most popular stocks, but I don't look at it in terms of stock or option volume. I look at the bid-ask spread. So for those of you that said I have no idea, please tell me. The answer is number 4, bid-ask spread. All right, and the last question I have for you, and then we're going to do some learning, and it actually really starts with this question. All right, so what are the biggest risks to an option trader? Number 1, directional risk, delta. Number 2, time risk, theta. Number 3, volatility risk, vega. Number 4, all of these are equally rated in risk. Number 5, it depends. Now, this one's taking people a little bit longer to answer, and I understand why, because this one, out of all 3 questions, this one you have to think about for a little bit. Because there is directional risk in options. There's definitely time risk in options. We've noticed in the last year, especially when you look at what's happening recently, there is volatility risk in options. But are these equally rated, and does it depend on anything? And that's the answer. Those are the answers we're looking for. There really isn't a wrong answer here, but I do believe there is an answer that I believe is more correct than any of the following there. All right, so we're going to shut this down. If you want to weigh in the next 3 seconds. 3, 2, 1, close the poll. And here's our results. And Jay, so 6% said directional risk. Well, there is directional risk in options. So, technically you're right. 15% said time risk. And absolutely there is time risk in options, especially if the stock goes nowhere. And so you're right. Volatility risk or Vega risk. 12% said volatility and Vega risk. Well, if you said that, you're also right. But the next 2 are interesting. All of these are equally rated in risk. You know what? Believe it or not, they're not. Because if you have an in-the-money option, you're going to be more directional risk than time. and volatility. If you have an at-the-money option, you're going to have more time risk than directional. If you're buying an option before a major event, you could have volatility risk. So they're not equally rated. So the real answer is, which most people answer correctly, is it depends. It depends on certain factors. And we're going to talk about those factors right now. So let's take a look at this chart right here. Now, if you look at this chart, you may think over here to the right, okay, yeah, that's a typical long call risk graph where you have limited risk and then you have up here unlimited reward until you get to a stopping point. All right, but when we look at different risks, there's your price risk right there. That's your absolute dollar risk. This is what delta risk looks like to an option trader. We know that deltas of options can go from 0, that means something that isn't going to move at all, that's almost worthless, to 100. And that means that the option is deep in the money and that for every dollar move that happens in the stock, the option is also going to go up or down by $1. All right, we got that. Great. Let's see what else we have in terms of risk. So this is delta risk. And delta, remember delta is what? It measures really the speed of the option relative to the stock price. So if you've ever bought an option before and you see a stock price go up and the option price isn't affected that much, it means maybe you bought an out of the money option that was far out of the money. And so maybe your option only went up 20 cents for a dollar move in the stock. And if that's the case, then you're looking at something that that 20-cent move may have been, we relate that as a 20 delta option. All right, the delta of the option gives us an idea that day, and that day only, of what the theoretical move of that option should be relative to the stock price. All right, and each day that delta is recalculated. All right, so the next one I want to show you is Fada Risk. So this is theta risk on a long call option. Now it looks like a kind of a bell curve or a reverse bell curve. Let me show you what this means. If you're on either side of this means you either have a way out of the money option that can't lose any more time value because most of it's gone already, or you've got something that's so deep in the money, it's moving dollar for dollar with the stock and not time. All right? Where time is most affected is at the money. Because an at-the-money option, if the stock doesn't drop, if it moves sideways, with the example that I'm showing you here, where a stock's just kind of creeping along, every day that stock doesn't jump up or down means that you're on the bad, as a long call buyer, you're on the bad side of time decay. And that's why you see time decay is at its worst when you're at the money. All right? And so there's ways to negate that. We're going to talk about that. There's ways to negate all of these risks, and that's the purpose of what we're talking about today. All right? Next, so this is your Vega risk graph. And if you look at Vega is volatility, and this one's quite different. See, as volatility goes higher, that's great for an option buyer because volatility actually adds to your option premium. Now, there's ways that volatility can go higher. One could be collapse on the market. You get a collapse on the market, volatility is going higher because people are nervous. And that'll make both the calls and the puts, the time value in those, go higher. Now, what happens when the market drops? Well, that's great for put buyers. That's not great for call buyers, but what will happen is volatility kicks up. Then call buyers may not lose as much as they think. Right, so that's what this graph suggests, is that if Vega increases, if volatility increases, we should see an increase in our time value, which is mostly going to happen at the money. Notice out of the money and in the money, Vega doesn't happen as much. So remember when we talked about being equally weighted, not being the correct answer? This is why. In the money, at the money, out of the money options have different things that happen to them with the Greeks. So, is there a temporary solution to negate all of these Greeks with a single event? And the answer is yes. There is one event that can sedate option Greeks for a short period of time. And earnings is that one event. And so what I want to show all of you in the room today is how we look at stocks and how we look at earnings and how we can look at buying a call option or buying a put option and actually putting some of these Greeks on our side, especially time and especially volatility, right? Because we want to take that directional trade. We want to take that directional trade in Schlumberger, which we did, and that's doing really well, or Baidu, or Caterpillar, These are trades that directional trades. But you know what? When you're coming into an earnings season, certain stocks can be affected a little differently than others. They don't all have the effect that I'm about to show you, but some of them do much more than others. So I want to show you what it is we're talking about here. Now, the worst thing you could do at earnings, and we've all been there, every single one of us, if you haven't done this, then you're a beginner. You haven't traded options yet. All right. You haven't, walked the fire that we as the enough to be dangerous crowd have. All right. When you're a novice, you may not do this. If you do it, it's typically, I don't even call it your fault because maybe you don't know what you don't know. But when you get into trading this particular way, when you're looking at the retail public has this idea, I'm going to buy a call option right before the earnings announcement because I keep seeing the stock popping after market closes. Well, what ends up happening is you're buying on the worst side of volatility in time. Let me show you what I'm talking about. So this is an example of a typical earnings cycle, all right? As we get to earnings, volatility and time typically move higher into earnings, and they drop right out of earnings. Right? Some drop much faster than others. I'm giving you an example. I'm actually going to show you a couple of stocks that this happens to even more severely than this little drawing I put here. But volatility tends to move higher in earnings and lower out of earnings, more or less for most stocks. All right. So what we're looking at is the last thing we want to do is buy the day before or the day of earnings because you're buying the most expensive volatility that's out there. It's kind of like we were using this example in one of our partner classes last month, and we were talking about buying tickets from a ticket scalper for the Super Bowl or for the Beyonce concert right before it happens. I mean, you're at the stadium, you don't have tickets, and you see this mad rush of people going in. You got a crowd, and you got a guy that's trying to sell 2 on the front row. And you know what he's doing? He's waiting. He's waiting because he knows he's going to get the most for those 2 tickets probably about the last hour before the concert begins or the hour before the Super Bowl begins. If he doesn't sell those by then, once that event happens, the value of those tickets start dropping. Every minute he's still hanging on to them after the gates open and after the opening kickoff. So we look at earnings the same way. And so if you're going to use direction with earnings, think about buying ahead of time. And so there's a couple ways we can do this. Number one, and you should be able to get this from anybody's site, not mine. But, we have a thing called an earnings ranker tool. And what the earnings ranker tool does is it allows us to go in and look at earnings and try to find things like the fundamentals. Which companies have actual earnings, the most actual earnings above their estimates? Which ones have them below their estimates? And then, of course, we can all find calendar days to next earnings and to past earnings. But I want to kind of show you a little bit of how this works. So I'm going to back out of here. I'm going to pop on over to earnings effects. I'm actually going to go to earnings ranker. So to get there, I go into the tools, and I'm going to come down here to earnings rankings, and I'm going to look at, let's go ahead and look at pennies and weeklies that are trading over 100. All right. And so I'm going to show you stocks that have of the stocks, the ones I'm looking at, the ones that have the most estimated actual above earnings. Now, this is only showing right now kind of 1 and 0. So in the last quarter, Baidu beat their earnings, Google, Priceline, LinkedIn. And you come down here a little more and you can see, wow, Goldman Sachs missed, Tesla. I don't have data on Tesla yet. UMP missed, CVS missed, Amazon missed. We know Amazon missed because I remember what happened to the stock. But what you want to do is you want to find stuff that most people don't have access to. All right. And one of the things that we do is we actually have something called earnings effects. So I can actually go in and I can look at price changes and I can see, well, what had the best price change before 4 earnings? All right. So I can go in and I can get my list of stocks and I can say, out of the stocks I look at, which ones had the best price change before 4 earnings? Netflix changed on average about 6%. Gilead Science, 5.71%. Baidu, 3.64%. Now, these are the mean averages. All right. Now, the next thing I like to do is I like to look and see were these all pluses or all minuses, because if they're a bit of both, that's not a pattern. So I look down and I go, whoa, there's Apple. Apple had a roughly about a 4% price move before earnings. All right. And this is the week into earnings. 4, up 2, up 5, up 5 the last 4 quarters. This is good to know. All right. And I go along and I do this. And so earnings effects allowed me to look at price change before for earnings. And how about this? IV, the implied volatility. All right. Which ones go up the most before for earnings? So I'm going to search the same list and I want to see what rises into earnings the most. IBM, look at number 2, Apple. So Apple has risen. They've seen a volatility increase of over 35% on average the last 4 quarters, right? And then there's Chipotle, Disney, Home Depot, Gilead Sciences. So these are ones that have had double-digit moves for the last 4 quarters and have had the most jump in what we call the percent change, all right, heading into earnings. This is great stuff to know because what it does is it tells me, okay, well, if I'm bullish on IBM or I'm bullish on Apple or Chipotle, if I am taking a call option into earnings and the stock goes nowhere. Now, if the stock goes down, I'm still going to lose money. All right, if I'm a long call trader, that's directional risk, but I won't lose as much. If the stock goes up, I'm still going to make money, but maybe I won't make as much. But what I'm doing is I'm trying to negate those big two, time and volatility. I got volatility on my side, at least based on history. On history is telling me these things tend to move up into earnings. That's good. But where is my risk? My risk is when I hold these through earnings. And I want to show you what I'm talking about. So we're going to look at Apple because Apple popped up a couple of times. And I want to show you with the earnings ranker tool what I'm talking about. So we look at a chart of Apple. And I already know Apple beat the last 4 quarters. All right. Maybe their guidance hasn't been the best. Maybe the analysts are now saying, oh, I don't know. Now they're cheering Apple again because of the latest iPhone they came out with. All right. So I look at this and I say, all right, their actuals are beating the estimates. All right, anybody can find that. But let's go look at what the earnings effect tool can do. And what I can do with that, and I just showed it to you, is that pre and post earnings affect both price and volatility of stock and options. And we have years of data to look at companies' earnings numbers and how they affect options the most. So here's a chart of Apple. All right, this chart is a recent chart of Apple. And I want to show you now what Apple's implied volatility chart looks like. And you can see here that it jumps, goes up, goes down. All right. So now what I'm going to do is I'm going to go in and I'm going to look at earnings effects. I want to see how did Apple perform before the last 4 earnings and after the last 4 earnings. I also want to look at what it did in volatility before and after. So here are the results of this poll that I did on my own website. Number 1. Before the earnings report, Apple, like I said, has been going up a little more than 4%. I showed you that. All right. I don't know if I showed you this, but after the report, now this is price. This is not options. This is the stock. The stock has risen an average of 4% into earnings. Now, the 4% that it does after earnings, look at it, -7, +4, -7, -2. So looking at this chart, where is the safety net for Apple? It is before earnings. By the way, Apple's next earnings are estimated on 4/25 after market close. All right, that's good to know because we know that if we want to look at Apple as a potential earnings type trade, well, I have until the 25th to do so. I believe the 25th falls on a Monday. Jay, could you just double check that for me and let me know? I believe 4/25 is a Monday. I think 4/22.
425 is one.
Yeah, so 4/22 is what I'm looking for, as that's Friday. It's time to close it up. So what we need to do is we need to also look at volatility. All right, so it's nice looking at price, but what did the options typically do? All right, well, check this out. So this is the IV before the earnings report. And remember, I just scanned and I just grabbed the top 3. IBM had that big jump in volatility, but Apple did too. Apple had over a 35% jump. And every quarter it was moving higher. This is good. It helps with time. It helps fight time decay. After IV, look what happened. IBM, big drop, 41.92%. But look at Apple, 41.86% drop in volatility and also drop in what? Drop in time premium. So we don't want to be scalpers sitting out there holding these Super Bowl tickets, in the third or fourth quarter. By then, they're, you might as well burn them. All right. So from here, what I'll do is I'll start to come up with some sort of a layering concept. And my layering concept is very simple. What I can do is I can use a application that we have on the software called the Money Calendar, which several of you know about. And what I'll do is the Money Calendar will give you a quick little synopsis on it. We search hundreds of millions of data points every day. All right, we look at all stocks. We drill it down to the top 400. All right, the top 400 stocks and ETFs. Used to be the top 250, but now we're able to expand a little bit more. Top 400. And what we do is we look for patterns in those top 400 stocks each day. And we're looking for patterns that are 90% or better. All right, 90% or better, either bullish or bearish. Now, we'll find typically bullish or bearish patterns each and every day. So if you look at, for instance, April 12th, you can see April 12th today, we had 84 stocks that over at least 10 years back had either a 90% bullish pattern or a 90% bearish pattern going forward. All right, 79% were bullish, 21% were bearish. All right, and so from there, I want to go and find stocks that might fit that pattern. Well, look at this. Lo and behold, Apple is also on the Money Calendar right now. All right, Apple's been clustering around now on the Money Calendar for the last couple of weeks. All right, so it was even good the last couple of weeks. But now it makes sense because now we're actually kind of going into earnings as well. So, we're looking at, for instance, 9 days. Over the next 9 days, Apple was profitable by 100%. Right, that means 10 of the last 10 trades around this time frame netted an average $2.78. And so I look at that and I'm like, all right, my largest trade was $10. My largest losing trade, well, there wasn't one. So that's why that's pegged at 0. So then we move along and we see the Money Calendar and we see, all right, well, let's take a look at each trade. And we can go across here and we can look at each one of these trades every year. Was, we had a couple of them that were $1.50. We had a couple of them that were 3 points, a little more than 3. This one here had 10-point move. And then last year we had a little bit better than a 3-point move. And you can see that I'm looking at 2015. You can see that 3-point move was from the open of day 1 to the close of day 9. Look what ended up happening, though. 124 got as high as 132, maybe 133. So it really was up, that good 8 to 9 points. So, we're kind of projecting a move of 5. All right, we're putting a conservative move of 5 points in because Apple is a stronger stock today. It's a higher dollar stock today than it was over the last couple of years. So this is important to understand. All right, so what have we done here now? We have looked at earnings cycles, and we noticed and learned that certain stocks start to the buyers come into these calls and puts, and they start bidding up these option prices simply because maybe they're speculators, maybe they're they own a bunch of stock and are trying to hedge their position, because put prices go up too. Call prices and put prices will go up pretty much parallel in terms of volatility. And you got folks that are trying to spread these things. You got folks that are selling naked puts and, doing all kinds of things. But all of this price action adds to the volatility increase, right? So we look at that and we take a look at what's happened in the last 10 years of price. We take a look at what happened last year in price. We take a look at what happened with earnings and what's going on with the earnings. And so what do we do with all this information? We do a couple things. We look at high option implied volatility or rising option implied volatility, a high degree of future predictability, and from there, that equals the appropriate options strategy. All right. So the appropriate option strategy with Apple, I'm going to show you the appropriate option strategy. Now, my legal team, my legal eagles, have told me I can't take this trade. That I can't take this trade until after I show it to you. So I'm showing it to you. All right. So what this trade consists of is being long AAPL, April week 4, 110 calls. All right. And so I throw a $2 or better on there. This is going to be a small short-term trade. All right. Now, last time I looked at these, they were trading around $1.70. $1.73, I think. I'll show you in just a moment. $2 or better, exit for a 150% profit. That's a $5 credit, all right, on or buy April 22nd at market close. So on Friday, April 22nd at market close, this is like a chess match. All right. Anybody in here good chess players? Or even better yet, how about some pool sharks? Do we got any pool sharks in here? Because a good chess player will tell you it's not the move you're making, it's 2 or 3 moves ahead that you're thinking about. Same with a pool player. A pool shark is not hitting the, if they're playing 9-ball, they're not hitting the 6. They're hitting the 6. They're also looking to where they want to draw the cue ball back for the next shot. And that's what we're doing. We're looking at, yes, I want to do this at a $2 or better. And because this is such a cheap option price, I'm willing to risk the entire $2. All right. And the reason why is because guess where support is on this trade? 108. Well, 108 is a little more than $2 from where the stock price is right now. So in that case, I'm willing to risk the entire 2. Now, if we get to 5, I want to get out. If it doesn't do either, then by Friday, April 27th, the market close, exit the position for whatever the value is. Now, I promised everyone I was going to show them how to place this order as part of this webinar. So let me show you that. And then I got another stock for you too. So this trade looks something like this. All right. Here's the virtual options order form. Again, another thing my legal team told me to do is use the virtual options order form. So you can see, this is no different than a real option order form with one difference that it's virtual. So what I'm showing you here is a virtual options order form from Options Express, right? I don't care who you use as a broker. Remember, I'm not your broker, all right? And I don't care who you use as a broker. So what I'm telling you is that if whatever you use, you can translate this into any options broker, right? So April week 4. So notice first, we're looking at the April week 4 options, right? The 110 calls, and we're looking to buy to open. This is the part where you put in what works for you, okay? That quantity. The limit price is $2 or better, all right? That means I'm not going to get filled at any worse than $2. And a good till cancel order, I do these quite a bit. So if in case I don't get filled today, then I might get filled tomorrow. All right. For example, I was looking at a trade in Yum Brands, and Yum Brands was, one of those trades where, I was looking to get filled and it kind of did, it kind of didn't. It was there and it wasn't, it's there, and it wasn't. Well, it was there today. If I don't get filled yesterday, then today is another day. Perhaps I can get filled. And so, I see that that this does happen on occasion, where I need to have that in. So in case I don't get filled today, maybe I'll get filled tomorrow, right? Once you're done, you go ahead and preview that order. And this is what an order preview looks like. So for example, I'm looking at Apple, and I'm looking at, again, if I do a $2 or better, am I going to get filled if we're at 171 by 173? Absolutely. In fact, you should get filled a lot better than 2. If this is your bid ask right now. And this has changed, by the way. I put this together about an hour ago before we jumped into the webinar. So I'm sure it's changed because the market moves up and down. So 171 by 173, and this says buy to open, 1, Apple, week 4, 110 call. The contract size is, 1's good for 100 shares of stock, so that's what that means. So you're buying $2 times 100, or $200 plus commissions. This is an example of what a commission would cost. Here's an estimated order total. And so this is what you see, and you're like, all right, yeah, okay. So what does this control for those of you that are new? This controls 100 shares of stock at $110. That means this controls an $11,000 position for $200. All right. And again, what are we doing as ticket scalpers? I got my tickets for Apple. Hey, who wants Apple? 110. Who wants it? Who wants it? I'm sure there's going to be plenty of people that are going to want this if the stock's trading at 115, by the end of next week. That's what I'm hoping for. That's what my rules-based trading is all about. 115 is not something that is uncommon at all. I'm looking to take that $2 option and turn it into a $5 option. All right, before earnings. So that's Apple. And then, when I'm done, when I place that order, I click on place, then the order will get filled. And then I want to immediately do this. I want to immediately go back once I'm filled, and I want to create that sell to close. This is a part that so many people get wrong. I can't explain how many people get this wrong. They get the order in, yay, my order's in. And then they forget to put the exit order in. And then how many times You don't have to answer this question to me, but how many times you put an order in, you forgot to put the sell to order in, it went up, it hit your market, and it fell right back down. And you were like, well, what happened? Well, what happened was you didn't finish the job. Okay, you didn't finish the job. And so finishing the job means go in there and put your sell to close in. All right, and put at least half in a double. All right, which means if you're only trading one, you can't put half of one in. But, if I'm selling one, I'd sell the same thing, sell to close one, limit of 5. Now I want to, I bought it for 2, I want to sell it for 5. That's my plan. And then I preview that order, and then I move on from there. So, Jay, are there any questions at this point that you see that are maybe popular ones that maybe I could answer at this point before we should see the next stock? You're welcome to take the mute button off and then start talking to me. Okay, I guess that either A, I'm answering everybody's questions, that this is easy so far, that what we've done is we've taken a rules-based trading system, and what have we done? We spotted opportunity, we've created that low risk or that appropriate risk trade, and then we're planning and executing and managing all in once, and that's what we're doing here. So let's move on, and let's take a look at the next item up for bids, and this is a bear, all right? Now, this is one, I put this is not a today, guys, all right? This is not a today stock, all right? And the reason it's not a today is because I'm looking down the road. I'm looking a little bit farther down the road. This is next week. So I want you to take a look at this one going into next week. WYNN Resorts, WYNN. They have an earnings release that's scheduled for April 28th after the market close. And the current stock price that I saw on this one was $97.50. I'm actually going to type it back into my other computer screen and just see 90. Oh, it's dropped off a little bit. Isn't this something? So WYNN Resorts, this is an interesting one. The market's up 18.5 points as we approach the close of today. I see that. And bonds are down, and currencies are up, and crude oil is at highs that most people didn't even think were going to happen. All right. I mean, it seemed like just yesterday we were putting out the report when crude oil was trading in the 20s, and now we're in the 40s again. That's just absolutely amazing. It surpassed my expectations in terms of what it's done so far. And a lot of you that are on here, we did a webinar not too long ago that had we did case studies on OIH. Buying the July 25 calls, and we did case studies on loophole trades, or what we call spread trades, and we even did a case study on a butterfly. All right, and we're going to do some. I'm going to do a seminar for you guys sometime next month on butterflies. All right, I'm going to do a whole seminar on just butterflies because that's one that I know a lot of people would like some more information on. And I'm going to do that. That'll be a whole seminar, and I'll make sure every one of you in the room is invited to that. But right now I'm looking at, again, a stock where the whole market, most of the market's up. When I look at my screen and I look at, what am I scanning? What am I looking at today? Well, practically everything on my screen is up with the exception of, well, Tesla's down. It should be. It had a big run up. But then if you look a little bit farther, you look at WYNN Resorts, WYNN. That's a stock that's also down for the day. Actually, she's down for the week. Excuse me. I was looking at a long-term chart on the stock, but yeah, I mean it's not doing what the stock should typically do when the market's when the market's out there moving higher. So this tells me that this might be a great one to be looking at as we get closer and closer to its earnings. Let's take a look at it. So here, we do the same thing. I run the scan. I run the earnings effects. What has earnings done to WYNN Resort? So this is the price changes. Before, last 3 quarters, WYNN has gone down before the price change. All right, an average of about 6%. After the earnings report came out, it bumped up, it bumped down, it bumped up, it bumped down. So no pattern. The pattern is before earnings. The pattern is more clear to the downside. What about volatility? Well, volatility is definitely clear to the upside, all right? Double digits to the upside, so it's going to help for that short-term option trader. But you do not want to be in this one after earnings come out if you're long options. You want to be hitting the road, All right, because 24% average drop in volatility means that you're going to see 1/4 of your time value drop in a day. So we don't want that. All right. Now, I looked at the money calendar for WYNN, and I spotted something very interesting because I went in a different way. And I said, show me all the WYNN trades that the money calendar is projecting. All right. Now, outside of this room, you won't see this kind of, well, my members get this access every day, but outside of the room, you won't see me rank it this way. But I went and looked at WYNN, and I was looking for clusters. And the clusters are all kind of happening. There's several of them happening, somewhere about 10 days from now. But between 5 and 10 days from now, the pattern to the downside starts to visualize itself, starts to show itself. So what am I going to be looking at? Next week, all right, next Monday, I want to take a look at WYNN because the pattern starts next week. The pattern of what? Not so much the stock going up and down, but the pattern of the volatility. Notice here, up into earnings. Notice here, up into earnings and then slap back down. Well, it hasn't started turning to move up into earnings yet, but that's going to happen real soon. So watch that volatility chart. All right, watch that. And what we're looking at is we're looking at that 7 to 30-day volatility chart, the at the money implied vols. All right, because that's where all the volume is, seems to be around the near money options. And they're going to tell us when it's time to be a ticket scalper for puts. All right, for puts on WYNN. Okay, so there you go. And so let me just, before I do a summary, let me show you something else that I want to show you, all of you, this. I haven't shown this to anybody yet. So you're the first people to see this. But I'm going to jump to the money calendar. And this is the money calendar for April. Yeah, it looks pretty nice. Looks good. You know what? Let me just bring this down a little bit more. Yeah, it looks nice. It's nice and green. Then we start getting into the end of April. Starts getting a little orange. Want to see what May looks like? Watch this. So I'm going to change from April to May. Boom! Look at all that red. Buy in November and go away in May. And you want to see just how accurate that is? Well, for the top 400 stocks and ETFs, we are seeing, as we get May 4th, 88% of anything that has a 90% or greater pattern to the downside. All right? 80% on the 5th. 98% on May 12th. Well, let's go look and see what we're talking about here. So I'm going to click on it. And I can see here that the big profit numbers, the ones that are really kicking to the downside, BTU, there's WYNN again. There's IBM, Fossil, Las Vegas Sands. I like when I see WYNN and Las Vegas Sands in here at the same time. But you start coming down here, you can start seeing, stocks that, that I like right now, like Caterpillar, that maybe as we get into the middle of May, I'm not going to like so much anymore for maybe even a short term. Some of these are 30-day trades. Some of these are 8, 9, 10-day trades. But I wanted to just kind of show you that for a little bit to show you, what I look at on a regular and daily basis, what my members also have access to on a daily basis. So, in summary, if we were to take a look at all of this and kind of throw it all together, it kind of looks like this. So, my trading tools, all right, Tom's trading tools. You look at things like earnings effects, which we did today, can give us a past history on price and earnings movement before and after the event. All right, and of course, the money calendar is just one of the directional rules-based trading strategies we use to give us high probability predictions on future price movement. And of course, I offer alerts and continued education on this to all of our members. But I wanted to summarize. I wanted to show you that, and I wanted to show you, just a couple more things here. Those of you in the room that are members, you're here. We do this on a regular basis. I want to show you something really cool. We only offer this. Actually, we haven't offered this in a while, but we've been offering it to our subscribers. And that is something that I want to offer to you, to all of you in the room this week. And that is, unless you're a partner, you're going to have the ability to upgrade or to register for what we call our professional tools package. And our professional tools package, let me just type it in here real quick to you. If you look in the chat window, this is where I want you to go. http://www.tomgentile.com/professional Trader. All right, I'm going to put that out there. If you click on that, that's going to take you right where I just went. I just clicked on that link. All right, you go to that link, and what's going to happen is it's going to take you to a page that you can't find on Google. You can't find it unless you have this link. You will not find it. We don't offer this out there on the front page of our website. This is something that we offer on every once in a while. We do offer this, and I'm offering to everybody here this week that's watching this video. And so this is a huge package. All right, we're talking about over $7,000, and it's because it comes with our TradeStream real-time package. All right, which includes we do at least three webinars a week during the market hours. All right. We have the money calendar. That's our patent pending application. That is, there's nothing else like it out there. We have dark net contrarian signals. This is our answer to Elliott Wave. If any of you have ever been an Elliott Wave trader, then you know this. Elliott Wave signals they're great, but the problem is they change a lot. It means when you get new highs or new lows, the wave counts will change. We have a way of doing what we call contrarian analysis, where the wins are wins and the losers are losers. And, we have B for buy and we have S for sell. We make it very simple, contrarian strategies without the wave counts. That's something called darknet. We have Tom's option tools, years and years of back option data. You can test any strategy at. You can even make up your own. We have some of our members that actually make up their own strategies in the strategy analyzer, and they've created their own option strategy. And then, of course, Tom's Trade Alerts, which is my weekly service where I offer case studies and scans and how-tos, which are very timely. Now, this is typically a package that we offer for $599 a month, but we're offering it at the annual price of $23.88. So pay $23.88 up at once, and that actually equals $199 a month, which is what our Complete Trader package is. Our Complete Trader package does not come with the real-time piece. And so we're really offering you the ability to go pro with us at our $199 a month if you pay it all up front at once, the $23.88. And once again, you can see that, and that is available at www.tomgentile.com/professional trader. I'm going to put it on the cue board here and put it out there so you can all see it that way as well. All right. And kind of rolling along through here. And so, guys, again, I'm doing this because, all right, because you're students of mine. I want to give you that 60% discount, all right, off of our regular price. So if you're in here today, this is not available to everybody. This is just available to the folks that are in this room, and those of you that got the invite. All right, it's available to you. It's not available to the outside public, not at this price. So any of you that are interested in stepping up to our Pro Pack, you're welcome to do so. All right, and we're happy to have you. I mean, we keep this small. We keep this as a small group. We want to keep it a small group because we want to be able to offer you that service that we do as an educational company, where when you email us, we get right back to you. All right. We have videos. We do over 100 videos. We've got over 100 videos already out there, and we do more videos each and every single week that relate to our option tools. And some of you guys, you've taken a class with me. Some of you guys in here get a publication from me. But all of you in here have access to me in one way or another. I'm giving you the ability to get something like the money calendar here every single day. You have access to everything that the outside public doesn't have access to. All right, so that being said, let me look and see if I still have Jay in the room. Because if I have Jay in the room, maybe Jay has any questions. Jay, did you see, or did we handle it?
Here. We're handling them pretty good. We got them. And if by chance people didn't get their question answered, hit us up at support@tomgentile.com, and we can file up and follow up from there.
Absolutely. Let me throw that in there for you guys too. So if you have questions on the webinar, support@tomgentile.com. I might also add, and I think everybody knows this, but it's worth repeating. We do not give specific investment advice. If you ask me where I think something is going, that's a me to you question. I don't answer that. I'm not your broker. But what we do is we try to educate. I do my best to educate you on how to spot trades, how to learn how to fish. All right. It's one thing for me to, like I gave a couple of trade examples out, the Apple trade, and I gave out another example with that I'm looking at next week in WYNN. But it's one thing to get these handed to you. It's something else to learn how to do them yourself and actually step up and become a professional trader. And so, like I said, we have tools that are available nowhere else. Right? We are filing patents on many of these tools in here because first of all, they're not available. You can't find them. I mean, you can't go out there and Google my tools. You have to know me. You have to be invited in, and we do that because we keep our audience small, right? We only can handle so many people, and so I opened this up today because I wanted to give everybody the opportunity to take advantage of this. And so there we go. So Jay, any last words of wisdom from you?
Other than that you've just discussed, no, not for the most part. You've got it all well on hand, and like I said, we stand by at support, ready to help and follow up. And you're going to have the recording of this out, yes?
Yes, I will. We'll have the recording out here shortly, probably by 6 p.m. Eastern Standard Time, so not very long from now. And also, for those of you that are signing up, we're going to also give you a video course throughout the week, the first week of you signing up. So I want to teach you how to get started using tools. Everything from how to create trades, how to scan for trades, how to use the money counter, how to use Darknet, like we use them, etc. So we want to put you in the driver's seat, and also you'll be also getting access to our live webinars that we do every Tuesday, Wednesday, and Thursday from 2 p.m. to 4 p.m. And so those are great. We do them every single week. I think we probably put out about 4 webinars a week, guys. So get an idea of the amount of hand holding and shadowing you're gonna get between me and my team. So anyway, thanks a lot for you taking your time out, and I enjoyed it. I hope you did too. You'll get the recording to you real soon, as well as I'll make sure you get a link to the special that you see here on the screen. Thanks again, everybody. Have a great day, and I'll speak to all of you real soon. Thanks again.
Thanks, Tom.